Welcome to the FMLS Market Intel Report. I'm FMLS Chief Economist Leslie Appleton-Young. In this report, I'll be focusing on the most recent macro data so we can gain an understanding of what's driving the housing market and what lies ahead. If I were asked to pick a word to describe what we've seen so far this year in 2025, it would have to be disappointment. Here's why. Recent economic reports show an economy that is still strong and also showing enough minor cracks to support the wait-and-see approach to just about everything that we've seen in recent months. And it's the anything can happen that continues to roil the financial markets and consumer spending decisions. Here's a brief rundown. Prices rose 2.4% in May, up slightly from 2.3% in April, perhaps reflecting the initial impact of the tariffs that have been imposed to date. Inflation remains close to, but not at, the 2% Fed target. Job growth was moderate, increasing by 139,000 new jobs in May, slightly surpassing expectations. The unemployment rate remained steady at 4.2% for the third consecutive month. Overall economic growth dropped 0.2% in the first quarter of 2025, and about face from the 2.4% increase in the last quarter of 2024. Note also that the Fed recently lowered its 2025 GDP growth forecast from 2.1% to 1.7% as tariffs reduce trade flows and subdue both consumers and businesses. Mortgage rates remain elevated. Last week, rates decreased slightly to 6.84%, down from 6.85% the previous week. This marks the second decline in 5 weeks, a modest reprieve for prospective home buyers, but they remain 20 basis points above early 2025. As a result of all this, the Consumer Sentiment Index from the University of Michigan has dropped from 74 in January to 52.2 in both April and May, its second lowest rating on record. In the housing market, this is playing out with slower sales and more listings. Realtor.com reported that listings in May rose above the 1 million mark for the first time since December 2019, increasing 31.5% over just last year. But despite this, sales are running below 2024. As noted by Selma Hepp, chief economist of Cotality, yes, there is more inventory, but it's almost like too little, too late. What should we expect going forward? NAR's revised 2025 forecast has existing home sales increasing 6% this year, prices rising 3%, and mortgage rates declining to 6.4% by year end. The stronger second half implied by this forecast depends critically on lower rates. This will only happen with continued slowing in the economy, allowing the Fed to cut rates with confidence that inflation will stay muted. One reliable marker of future housing market activity is pending sales. NAR's pending home sales index showed a monthly decline of 6.3% in April, quite unusual for the peak of the spring home buying season. Pendings were also down 2.5% from last year. In Atlanta, pendings have also been declining, with May's number off 11% from a year ago. In other words, at this point, all signs point to this year's housing activity little changed from last year. All of this plays out against a backdrop of on-again, off-again tariffs and other uncertainties. Where it will go is still up in the air, at least until we get some clarity on economic policy. Take a look at market intel on the FMLS website to access the most current market statistics. They are updated weekly. If you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this is Leslie Appleton-Young. See you next time.